All right, good morning, guys. So it's 11:17. I think I'm going to start the webinar for today. So as we all know, last week some of the REITs have already started reporting results, as well as SGX. So for today, we're going to do 3 results: first REIT, FCT, and SGX. And then the concluding main course, Jeremy will do an update on the Singapore's banking sector. Oh, just a reminder for all you guys attending our webinar. We have this survey, that the survey link that we send out every week. We would appreciate it if you guys can help us fill in the survey. So in order for us to serve you guys better, the survey is actually unique to every Monday's presentation. So we would like to know how you guys find the content for that particular webinar. So it would be good if you can spend a minute or so after every Monday's webinar to click on the link and fill in the details for us. So with that, I will start on the results first for first REIT. So as the title goes, strong sponsor acquisition pipeline to look forward to. The results table, gross revenue grew 6.3%, mainly due to contribution from the acquisition. All these details, I think, all these boring facts, I'll leave it to you guys to read it from the report. And then I think what I will touch on is the key takeaways for each result instead. So for first REIT, I think one of the key takeaways is that for their portfolio valuation, this time round is actually lower this year versus last year, year on year, and primarily that is because of the weak Singapore CPI figure. So as we all know, why we are having an accumulate call on first REIT primarily is firstly because rentals are in Sing dollars. Contracts are very long term for 15 years plus another 15-year option, and the rental escalation for their properties, most of them are pegged to Singapore CPI. So as I was saying, the lower property valuations is due to the weaker Singapore CPI for the past 2 years. So the negative CPI we have seen over the past 2 years has actually kept the amount of rental escalation that the properties have seen. So in fact, for the last 2 years, we've seen a flat or zero escalation for the properties because of the negative CPI. So that has actually affected property valuations. But the mitigating factor here is that for this year, Singapore CPI, the outlook is very much improved with generally improving economic conditions. We have the MTI coming out to make an estimate for this year's CPI to come in at about 1%. So that would actually provide some relief for first REITs properties in terms of the rental escalations that you'll see. And then remember last year at the start of the year this time, there was a lot of dark clouds in the horizon for first REIT, in that there were a lot of articles out there saying Indonesia is going to relax the REIT market, and then their sponsor Lipo Karawaci having more options. Maybe they want to maybe they want to lease REITs there. Maybe they want to move the REITs back to Indonesia. And then we have come out with several reports. We have said that that is pretty unlikely because of several factors. You can refer back to our reports then. So start of last year, a lot of uncertainties, and then last year, last quarter, there was a report saying that Lipo Karawaci is trying to list an office REIT in Indonesia as well, and that report, even though it's not a confirmed action yet, but that report actually states that the office REIT is going to yield something like 9%. Okay, and I'm not sure how the figures are going to add up, because if you're going to have a REIT yielding 9%, your 10-year government bond yield is 7.5%. I'm not sure how that's going to pan out. So in all, everything is still very uncertain. And for 2017, first REIT management has actually guided that they have a few acquisition targets lined up. And one of the announcements that came out with the results is the termination of the acquisition of this Siloam Hospital in Yogyakarta. That announcement first came out in February last year. Now the deal is cancelled, but the termination of the deal is only going to be temporary because the licenses for the operation of the hospital has yet to be approved. So that is going to take some time, and management is still confident of getting the deal through by 2Q or 3Q this year. And apart from that, they have two more hospitals lined up, which they're expecting to acquire hopefully by 2Q, 3Q this year. Total acquisition figure could add up to Sing dollar about 140 million. That is slightly more than the average acquisition amount over the past few years. So I think with this lined up acquisition targets, it actually demonstrates the commitment from the sponsor to continue to recycle capital via First REIT, via this capital recycling vehicle. And we all know that REITs actually thrive on not just rental escalations, organic growth, but also inorganic acquisitions as well. So with this commitment from the sponsor, I think that should dispel some of the doubts regarding the commitment of the sponsor to the REIT, to First REIT. So we still have an accumulate call on the REIT, target price 132. You look at the comparison First REIT between First REIT and P-Life REIT, you see that the PB is lower and the yield is also higher. So next I go on to Frasers Centrepoint. Okay, subject title supported by the Causeway Point pillar again. I'll first touch on what is on the table first, because I think this is pretty important. This could worry some investors in that when they see gross revenue tumbling 6.4%, they could start getting worried. But actually, bulk of this fall is coming from the renovation works at North Point. Those of you who stay around there should know. Occupancy is down over the past close to a year since renovation first started at the start of last year. And if you take away the North Point effect, the gross revenue is actually pretty flat. So a lot of this dip is just due to the renovation work, so not much to worry about there. So despite the fall in revenue, distributable income and DPU still was able to remain flat, and mostly is because management took more asset management fees in units, and so that freed up more cash to be distributed to clients, to investors. So I think along the past few quarters, we have seen that FCT was continually supported by the strong performance of Causeway Point, and Causeway Point is actually taking up close to half their portfolio in terms of rental income. So the performance of Causeway Point has been a very strong pillar in the history, in the performance of FCT. And given the importance of Causeway Point and the continued strong performance of Causeway Point over the past few quarters, I think it's important that we take a closer look at the mall and see if this historical strong performance is, firstly, whether it's justifiable, whether it's sustainable, and whether there is a likelihood of the strong performance slowing down. So we look at Causeway Point versus one of the other suburban mall, Tampines Mall. Okay, there are quite a few similarities in this mall. Firstly, both are suburban. Secondly, you look at the catchment area around both malls. For Woodlands Town, there are about 250,000 residents. Tampines Town, 260,000. So the catchment size is actually about the same. Annual shopper traffic, Causeway Point has 25 million. Tampines Mall has 26 million, so about the same as well. And then you look at the, if you look at the population size is the same, you look at the age distribution is also similar, because I think that would translate to spending power as well. Like it would not be very fair if you compare Woodlands versus say Punggol, because Punggol likely would have more young couples around there. So given that, because Tampines Mall actually has slightly higher annual traffic, slightly, just 1 million, but the thing is the net lettable area is lower, is more than 10% lower. So you can say, oh, maybe the shopper traffic is dispersed, is scattered over a smaller NLA. Maybe that could translate to a higher sales productivity for the mall, and that's why Tampines Mall can command a higher rate. But I'd like to argue that it is quite likely that the conversion rate of the footfall at Tampines Mall is likely to be lower. So conversion rate means the for every shopper you lure or you attract to walk through the mall, how much of a dollar spending are you able to milk? Are you able to get from the shopper from the shopper? So not just only you need to attract shopper traffic, you need to have a high conversion rate as well. So I think for Tampines Mall, conversion rate is likely to be lower because of the higher density of shopping malls around the area, because around the Tampines MRT area, you have 3 big malls. You have Tampines Mall, Century Square, and you have Tampines 1 as well. But for Causeway Point, it is just that one mall in the Woodlands MRT area. So given the likelihood of lower conversion rates at Tampines Mall, we think that these two malls are actually very similar. And if you look at the average gross rents for both, the fact that Causeway Point is doing about 10% lower versus Tampines Mall, I think that suggests that the recent strong performance of Causeway Point is actually not unjustifiable. So provided that management is able to do as good a job as CMT in terms of firstly attracting the different tenant mix, the different trade sectors that are likely to do well, if they're able to do the same, if they're able to attract the strong tenants to come in, the tenants who are able to get the sufficient sales, then I think the strong performance of Causeway Point will be able to be sustained. So next point I want to make is the North Point AEI that is ongoing. Management's target is for rents to increase 9% post AEI. And you wonder why, how would they be able to do it? Because they are serving the same catchment area, spending power is likely to be the same. Just because the mall is upgraded, you get 9% higher rents. How possible is that, and is that possible? So we would like to point out to you that management, this is not the first time AEI has been conducted. They have done it many times. If you look at our report, we mentioned that the previous AEIs to North Point, to Anchor Point, to Causeway Point, the ROI is the return on investments for all of these malls have been very good. And for the previous AEI at Causeway Point, post AEI they were able to get more than 10% increase in rentals as well, because of some reconfigurations of the tenant mix, and then they reduced the amount of big box retailers, I think down from 65% to something like a 50%. So all these little reconfigurations here and there allow them to actually get a good return out of the investment. So with all this track record, we are pretty confident of what the management can do for North Point. And I think management has also stated that the discussions with the tenants for the taking out of the tenancy after the AEI, the discussions are very much on track to achieve the 9% increase in rents. So for this year, I think the structural challenges facing retail industry still remain. We have the increasing threat of e-commerce. I think it's just gonna get more and more severe, especially now that there are a lot of factors facilitating e-commerce. You have last mile, delivery options improving vastly. Like you have Singapore setting up all the pop-up boxes, so delivery is just gonna get easier. You have Amazon is coming to Singapore as well. So I think we may not see as bad retail sales as last year, but there are not much catalysts inside as well. So with that, we maintain our neutral call on FCT. Our target price is $2, not far from what is currently traded, about 197. So with that, I'll pass on to Jeremy to do SGX.
Okay, morning. Okay, so SGX just released their results. So the title Securities Business Charged Up by Animal Spirits, and by animal spirits is actually a term coined by John Maynard Keynes, the economist. And his animal spirits refers to that human emotions could actually cause consumer confidence and in turn could drive up markets. So for this part of the results, right, we can see that actually the securities business have risen 12% year on year and 11% quarter on quarter. That was after the driven mostly by the post-US elections. So there was a surge in consumer investor confidence, and therefore the securities business is up. And so on the derivative side, the total volumes were up 5% year on year, but the average fee per contract declined from declined to 1.16 compared to 1.28 from a year ago. And this decline in the fees per contract was mainly due to the iron ore future contract rebates given to clients. We think that the rebates allow SGX to maintain 90% market share of the iron ore futures market. But most importantly, we also believe that they're going to leverage on their market share in the iron ore futures to expand the freight business as an adjacent market, and which is why they have purchased the Baltic Exchange for that purpose. So in the longer term, we believe that the enlarged ecosystem of the freight and iron ore derivatives will create a better client stickiness. And then on the cost impact side, there is a better guidance, right, of operating expense. The guidance is lower at 405 million to 450 million as compared to previous guidance of 420 million to 430 million. On the cost saving side, because of this positive guidance, our net income forecast is of course also we revise it slightly upwards, and therefore the higher target price of $7.75 compared to previous $7.69. And for SGX, we maintain the accumulate rating. Okay, next we'll move to the Singapore banking sector. Okay, so in this report, we actually discussed the challenges to the loan and net interest income growth. Most of the people in the market would look at expansion of net interest margins on the back of rising rates, and they will say that this is positive for banks. However, we would like to actually propose some negative conditions to that, and it might actually challenge the this positive impression of rising interest rates in our region. So in our report, we actually discuss two aspects. One is, of course, the high LDR, right, of the Singapore banks now. It gives them a little headroom to expand it further. And if they continue to keep it high, this might expose them to intense competition for deposits if it ever happens as rates are rising. And the second part is, of course, the leveraging of loans, deleveraging as loans shrink and deposits rise. This is in line with the regional credit cycle contraction. as in the report, we also put in, we also state that actually most of the regions where the Singapore banks are operating in are really reaching the private sector debt has already reached about 100 to 100 plus percent of GDP. So what usually that means is that the demand for credit will fall faster and deposits will tend to rise. So this morning there was a Business Times report which actually drew out the system deposits and loans and showed that actually for the month of November, the deposits have grew 6% year on year, while the loans have grown only 1% year on year. So this emphasizes the second part, right, about loans shrinking and deposits rising. But it also mentions that the Singapore banks may not be competing for deposits. Right? They will just say that, okay, if the system deposits are rising faster, so the Singapore banks may benefit. That part, we are not so sure. We will tend to believe that's the case because the Singapore banks have a very strong branch networks, which allow them to have a very, very high stickiness of deposits. However, if you read further in the article, it also says that the Malaysian banks and the Chinese banks are competing very aggressively. If let's say depositors want, if they desire 1% for the deposits, then you can look for the Chinese banks, Bank of China, or the Malaysian banks like CIMB, RHB, and Standard Chartered also that included. So what happens is if interest rates continue to rise, these banks that are operating here will look more attractive in that sense comparatively because naturally if they're going to rise their rates according to the benchmark rates, then people will tend to will begin to choose. So how this pans out will be quite interesting because if the banks are going to continue maintaining a high loan to deposit ratio, then you will actually put them in a tighter position. So of course, when it comes to all these dynamics, then you have a lower net interest income growth. And what is the problem, right, with weaker net interest income growth in this situation? So you have weaker ability to set aside provisions to increase the coverage ratio, and this would not come at the worst time because NPLs would rise further as high interest rates would reduce the ability to service debt repayments. So later on we'll show you some charts about how the coverage ratio is falling and how the NPLs are actually rising within a very short period of time. So the last part is expectation of strengthening US dollar weakens demand for US dollar loans for Asian borrowers, and this is quite impactful for Singapore banks because this, US dollar loans are the second largest loans just behind Singapore dollar loans. So, and the US dollar loans is also important because it is it's a medium for the Singapore banks to reach out to regional borrowers. Right. So in that portion, it will affect their business relation in the sense that how they will reach out to borrowers from within the region. Okay, so before we go to the charts, just a case study. This case study is to illustrate to you that under a rising rates environment, net interest margins generally will rise. As you can see, in all cases, it will rise. But it does not mean that net interest income growth will also be positive, right, as seen here. And even if it's positive, it may not reflect an optimal picture because the LDRs would rise up, right? So why the LDRs, if the higher you go, the tighter it is, because if loan deposit ratio is at 100%, which means is that every $1 deposits you have, you are funding $1 worth of loans. And if that ratio is too high, you risk coming to a situation of being underfunded, right? So generally, loan deposit ratios of 80 to 90% is acceptable. Of course, lower will give you a lot more headroom. And if you're 90, you are pretty stretched already. So in here, we can see that when interest rate rise, right, banks will always raise the loan rates more than the deposit rates. So if they were to follow through with that, you can see that although net interest margins would rise, but LDRs might fall in this case here, right? And then the net interest income growth would also come down. So there's a stronger correlation between the LDR ratio trending and also the growth trend for the net interest income. right? So what happens is if you allow your deposits to, if you don't compete for deposits and you don't change the rate for deposits and you lose more deposits than expected, you would also come out with a positive net interest income growth. In fact, it would be a lot more than the other two scenarios here. But your LDR goes up to 94.4%. And if it's at this high level, what's the next step? Can you even stretch it even further? So this is the contention, right? That high LDRs would give, as you move higher and higher, it gives you a lot less room for you to use this, to expand this ratio to grow the net interest income. So for OCBC, you can see that the general trend has been using the LDR to move up the net interest income growth. So I've alluded to the fact that optimally we should see LDRs at the tighter range, at the lower side. So that is, and while net interest income growth is steady. But of course, in the real world, that is not the case. So for Singapore banks, we can see that they have been utilizing this LDR quite a fair bit to drive up the growth. So, but OCBC has already started to move the LDRs lower, and you can see that the net interest income growth has also been impacted to some extent. And the last, as of recent quarters, first quarter, second quarter, 2016, the volume rate dynamics hasn't been favorable. Although the general interest rate environment has been low, but the cost of funds on other borrowings has actually crept up, but not the deposits for their customer, not for their customer deposits yet. So moving ahead, as we know that the interest rates are bound to increase, there's a lot of expectation for that. The dynamics will become more interesting. We might see that if it does go up, then of course it will impact the net interest income growth negatively. But we also believe that OCBC would move their LDRs to a conservative level. So we probably estimate it to be about 80. They'll probably move it closer to 80%. UOB, in this case, is also shows the same pattern. But we believe that their yields on their loans are higher, but it also corroborates with actually their higher NPL. So we believe that actually they are lending more aggressively, right, to widen the spread between the loan rates and the deposit rates. And then they would probably also keep their LDRs about close to about 85% to boost up the net interest income growth. UOB, on the other hand, had faced some pressure on the cost of funding, both on other borrowings as well as customer deposits, because its customer deposits also showed increase as compared to 2015, despite that for the first the 3 quarters in 2016, right, interest rates, benchmark interest rates have generally been low. So you can see that probably they are already feeling the competition, and they have corresponded with raising up the deposit rates. Okay, so for DBS, it's different from the other two banks. You can see that the LDRs have constantly been high, and now it's about on the highest they have since the beginning of 2008. So at this part, we can assume that in our scenario is that they have very little room to stretch further. But in 2007, towards the end of 2007 and beginning of 2018, they would probably have completed the acquisition of the ANZ retail and wealth management business, which will actually give them 5% growth on deposits and 3% growth on loans. So this will actually probably give them a year's worth of growth in this area of loans and deposits. Right. But other than that, this ratio here is of course very tight for them, and you can see that in since the first quarter 2016, their net interest income growth have been underperforming, and that is also due to the cost of funds on other borrowings, which have actually risen despite the lower interest rate environment. But their customer deposits rates haven't moved yet. So we have to see when interest rates rise. We will have to see how they will manage the dynamics again, right? Okay, so the next one, you can see here that the net interest margin expansion. Generally, when interest rates go up, yes, it will definitely go up, but how much will it go up? So our argument is that the expansion will be crimped by the faster rising cost of funds, right? As interest rates go up, so that's our expectation. To some extent, it might we still expect the customer deposits rates to rise along with the interest. And you can see here that the NPLs have started to rise since the first quarter of 2015. As interest, we know that of course the oil and gas industry is facing headwinds. Then with expectation of higher interest rates, that would also crimp their ability to actually service the debt. And we can see here that the coverage ratio has decelerated pretty quickly since the first quarter of 2015. And now the coverage ratio for DBS and OCBC, they are hitting the threshold of 100%, while UOB is still managing at about 115. So to me, the net interest income growth is very important during this period of time, because it really gives us an idea whether they have the ability to actually grow the provisions and then to actually build up this coverage again. So we compare it with multinational banks. We can see that large American banks generally reduce their LDRs from 2011 to 2014, while the quantitative easing has kept interest rates low. If we compare that to the Singapore banks, we can see that actually during this period of time, they have instead expanded their LDRs to keep up the performance. So our argument is that they could have, Singapore banks could have expanded their LDRs to boost performance too early. And we still argue that the use of the LDR is like a trump card, where you when the loan volume and rate dynamics are unfavorable, then you could use it. You could expand the LDR by cutting high cost deposits, right, and maintaining loans that can have a pass-through of higher rates. So now, since they've utilized that, so there's less room for them to actually use that. So as for today, we can see that most of the multinational banks here have all have lower LDRs, lower loan to deposit ratios than Singapore banks. So on average, they have their LDRs is about 74%. Okay, so the last part is the expectations for strong US dollar because demand for US dollar loans for Asian borrowers. So you can see here that the DBS has the highest percentage of US dollar loans, followed by OCBC and UOB. So here's the trend. For this 3Q15 and 4Q15, towards the end of 2015, there was expectation of rate hike. They hiked the rate in December, and at that time Janet Yellen guided for 4 rate hikes in year 2016. That created a lot of uncertainty in how the US dollar would be, and during these 2 quarters, we saw that the growth for US dollar loans have declined. Right. So after the second quarter after the first quarter 2016, more or less the markets have the Federal Reserve has guided that they will not raise hikes until they will not revisit the hike rate until to the end of the year of 2016. And this gave some assurance to the market and some certainty. So correspondingly, we see that there's a pickup in US dollar loans. And so finally, in the final quarter of 2016, after the US elections, we know that the rate hike is pretty certain, and the US dollar has also strengthened tremendously. So in this sense, we expect the US dollar loans to be negatively impacted. And this overall would, I mean, given that the strong composition of US dollar loans in Singapore banks, and this would generally, we believe, would impact the loan books in general. So finally, our expectations for 2017. So as if DBS continues to maintain the LDRs at a high level, we expect them to actually look out for more acquisitions to put on loans and deposits to grow the net interest income. And so this is probably the most cost-effective way of doing so. And we also expect that the US dollar strengthening would impact DBS customer loans the most. And then OCBC, given their conservative stance, they make work the LDRs lower to 80%. And during this period, then of course we will expect the interest income growth to be weak. But that also gives them the potential to expand it in the medium term. And if of course interest rates are going up on faster pace, this would benefit them. And of course, higher interest rates would also help the insurance arm of OCBC because they could reinvest the premium income into high yielding assets, when bonds would have higher rates following the increase in interest rates. Then finally, UOB, we expect them to keep the LDRs at about 85% and manage an optimal balance of rescale loans to keep the net interest income growth positive. One of the reasons we think this way is because UOB is still quite dependent on net interest income, and it's a very important business for them. So the recent weak, but the near-term headwind we feel is the weak performance from the Singapore construction industry. The UOB's, we estimate UOB's construction industry, Singapore construction loans to make up about 13% of their total loan book. So recently, in our report, we also indicated that there's besides the slowdown in the Singapore construction industry, there's also late payments by these construction players. So this could actually weigh down on the performance in 2017. So we are underweight on the Singapore banking sector, and then we downgrade neutral from previous accumulate for DBS, but our target price is higher at 1685 as we roll over to FY17 valuation. OCBC, we maintain neutral, also with higher target price as we roll over to 2017. And we downgrade reduce from a previous rating of neutral for UOB, also with higher target price of $18.97 as we roll over to FY17 valuation. Thank you. So if there's any questions, you can write it on the question box. And please remember to fill in our survey gizmo so that we could fine-tune our presentation for you guys.
Hi guys. Okay, we have a question on the REITs I presented. So we have a very sharp attendee who correctly pointed out the interest rates, interest coverage ratios for first REIT and FCT. And question is whether these two counters will be affected by rising interest rates. So rising interest rates actually affect all REITs, but of course those which have more debt to be rolled over, and then as well as those who has less of their debt hedged on fixed rates basis will be affected more. So the so our client is correct. You are correct in pointing out that First REIT and FCT, they are both actually having a quite a substantial portion of their debt due for refinancing this year. First REIT has about 35%, and FCT has about 25%, a quarter of their debt due. And but the good thing for First REIT is that most of their debt has been hedged on a fixed rate basis. But for FCT, it is just I think only 50 odd percent hedged versus if you look at CMT, which has 90% hedged. And this policy of hedging not as much has actually served FCT pretty well over the past few years because we know that interest rates have been low and it's been low for quite a while. But the rest assured that in calculating our target price, we have actually already factored in a 50 basis points hike in borrowing costs for these REITs, and this is already so all this higher interest cost is already factored into our discounted dividend model in deriving at our target price for both. And our risk-free rate that we are using is 3.1%, which is a very has a very good buffer against what you are currently seeing. The Singapore 10-year bond yield now is only about 2.4, 2.5. So I think our risk-free rate has a good buffer in there. Hi, there's a question on oil and gas as well. And the question is that crude oil prices have already moved up. Is it time yet to buy oil and gas stocks? But I'm very sorry that our oil and gas analyst Kong is on MC today. So very unfortunately, we would not be able to answer this question. But what we have on our house call is we have a buy call on Ezion. Target price is still a distance from the current price, but we have a sell call on Sam Marine. So I think in essence, in very short summary, our analyst is bullish on the downstream area of oil and gas, but more pessimistic on the upstream area. And if you don't mind, you can ask the questions again when we hold our next webinar in after Chinese New Year, or you can email our counsel as well. Hi. There's a question on the REIT sector. Are we still overweight on the REIT sector? So we are currently working on a REIT sector report for 2017. And what we are doing is that we are waiting for because we have some more results coming out this week. And we are waiting for the results to be out. And the REIT sector report will be out after this first round of results. But as of now, what you can see is that what we can confirm is that for the results that are already out, we are still bullish on first REIT. We have an accumulate call, and as for FCT is a neutral. And for the rest, do stay tuned to our sector report that should be out this week or next after the results, after the pretty heavy slew of results this week. Oh, guys, can I remind you as well to help us click on the survey link and then fill in your thoughts on what you think about what we have spoken about today for our webinar, because what we talk about every week is unique and we would love to hear your response for what you think are of interest to you and what you like or what you do not like about what we talked about for every week. Okay, I don't see any further questions. So with that, I will close our webinar today. We will resume our webinar in 2 weeks' time. So in the meantime, have a happy holiday and happy Chinese New Year to everybody. See you in 2 weeks' time.